This episode of the Old Dogs REI Network is brought to you by Mino Studio. Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manassero.
Hello, old dogs, and welcome to
Fun Facts Friday.
This is our once-a-week, only on Friday show, where we have special episodes not featuring guests, where I will share tricks, tips, terminology, and techniques that will help skyrocket you to real estate investing success. Today's topic is 10 tips for buying rental properties in today's slowing market. But before we get started, I just want to touch base with you, and I hope everybody is doing well. I hope that your real estate investing endeavors are going well. And hey, I just wanted to say, if you get a chance, send me a note. Let me know how things are going. I get real thrilled, excited when I get emails from people saying, hey, I just bought this property. It's good and encouraging for the rest of us to know. So I'd love to share that information with our listeners. So if you can, send me an update. Let me know how things are going. Also, if you have any questions, I'd love to hear about them too. A lot of those I will try to feature if I can on our Ask Bill segments, if that is something that might fit in there. And if not, I'll still get back to you and be able to hopefully provide you some good resources and things to help you in your ongoing endeavors here. Well, anyway, let's move on to our topic, 10 tips for buying rental properties in today's slowing market. Well, I know that title kind of sounds a little bit negative here, and that's not really my intention, but there are a lot of indicators out there that the market is slowing down on a national basis. Now, I'm one to say that there really isn't a quote-unquote real estate market. There are a lot of different markets, and so there's a lot of activity going on. But monitoring some of the top metro areas, there are some indicators. According to Bloomberg Business Week, the U.S. housing market, particularly in areas like Seattle, Silicon Valley, and Austin, Texas, appear to be headed for the broadest slowdown in years. Buyers are getting squeezed by rising mortgage rates and by prices climbing about twice as fast as incomes. There's only so far that can stretch, right? Robert Shiller, a Nobel Prize-winning economist who is famed for warning of the dot-com and housing bubbles, said in an interview that this could be the very beginning of a turning point. He stressed, however, that he isn't ready to make that official call yet. With increasing competition, rising interest rates, and rising home prices, a correction is approaching, it looks like. However, just because real estate prices seem to have hit a temporary ceiling in many areas throughout the country, that doesn't mean that profits from property investments are hard to come by. Even during a real estate market slowdown, stagnation, or depression, profits can be made if you know where to look. Just look at what happened in Seattle. I don't know if you're aware of this, but for the last 2 years, it was the hottest housing market in the country. I know we shared it on this show before, but it just lost its number one place to Las Vegas, according to the recent Case-Shiller Home Price Index report released. What happened? Well, that's a good question. Prices just maxed out and inventory declined. I mean, that's kind of what happens in these cases. However, people are still buying, but just not in Seattle Metro. Now, what is happening is people are buying in nearby Tacoma and Everett, where home prices are still reasonable, at least for the time being. Now, the bubble may have capped out in Seattle, but new bubbles were developing in the surrounding secondary and tertiary markets. And this is something that happens in a lot of different areas. I can cite Atlanta as one of those areas where this is still happening. Now, this podcast is really going to present some tips that real estate investors can apply or not apply in a slowing market that might help you in terms of your strategic property portfolio building. And hopefully it'll help you edge your success on your investments. So here are a few things that you might want to keep in mind. Number one, research and understand where you are on the curve. The concept of a property market cycle existing is not a myth. It's a fact, and it's generally accepted to be based on a price-income relationship. Now, we talk all the time on this show about emerging markets, and that's what we're really talking about. Check the recent historical price data for properties in the area of the country you're considering purchasing in, and try to determine the overall feel in that market for prices currently. Are prices rising? Are prices falling? Or have they reached a peak? You need to know where your area is on the curve of that property market cycle, or that bell curve there in your preferred investment area. That's key. Understand that area you're looking to invest in. Number two, get ahead of the curve. As a basic rule of thumb, professional real estate investors seek to buy ahead of the curve, or as I like to call it, at the base of the bell, looking at the curve as a bell-shaped curve, right? A bell curve, and being at the beginning of that curve as it's just starting to go up, I think is one of the best places to invest if you can detect that. If a market is rising, try to target up-and-coming areas that are close to locations that have peaked, areas close to locations experiencing redevelopment or investment. These areas will most likely become the next big thing, and those who buy before the trend will stand to make the most gains. As a market is stagnating or falling, many successful investors target areas that enjoyed the best levels of growth, yields, and profits very early on in the previous cycle, because these areas will most likely be the first areas to become profitable as the cycle begins turning towards positive direction once more. For example, in Indianapolis and a lot of downtown areas that are developing, especially for the millennials. When I first started buying in Indianapolis, I noticed that there were some areas near downtown that looked like great places to buy. I mean, their prices were going up really rapidly. And one of those was an area called Fountain Square. But as I started looking in that area, it was real hard to find very many good deals. But there was a bordering area called Bates Hendricks. And so I did invest, bought a little duplex in Bates Hendricks, seeing that as a potential next area to take off. Again, I was looking at just the market data, that what information was already available, looking at prices and how they were going up as we approached this area. So investing in that area, I bought a little duplex for like $55,000, and it was recently appraised at almost $200,000. It's a good move if you can find those areas. Let's go for number three. Know your market. Who are you buying property for? And as I mentioned, we were just talking about the millennials. If you're buying in a market for millennials, that's great. If it's a blue collar area that might be more just your hardworking workforce folks, maybe a solid C or C plus area, then buy for those people that are purchasing what you're looking to sell. You may want to change strategies in certain areas too. You may, for example, want to shift from a sort of a family market to go to short-term rentals like Airbnb, VRBO, or vacation renters. Think about your market before you make your purchase, though. If it's something that may be in transition, are you able to make that transition to adjust for the change in that market? Number four, think further afield. There are emerging real estate property markets around the country where local economies are going from strength to strength, where a growing business sector is pushing up demand, where local business tax incentives have been employed that are trying to attract more businesses, or maybe there's a major employer planning to relocate to that area that will provide hundreds or even thousands of jobs. These are factors that you need to know as you look at where you want to make your purchases. Look further ahead than your own backyard for your next property investment. I mean, you may have invested mainly locally around your area. And that, I always tell everybody, that's the best place to invest because you know it so well. But if If it's kind of maxed out, then you might want to look at a state or in maybe even different part of your state to try to find the kind of returns that you need to get. Number 5, purchase price. Set yourself a budget that will realistically allow you to purchase what you're looking for and profit from that purchase, either through equity growth and or rental cash flow. Pay less for properties in anticipation of a downturn. Now, if even though a lot of people are saying you cannot buy below market, I don't believe that. I think you really can buy below market, but you've got to wait, and it takes time, and you have to be patient, and you have to be creative. And I just think when you can do that, you're going to hedge yourself that much better for a declining market if there is a downturn, which there will be ahead. Number 6, entry costs. Research your fees and charges, all the expenses you will incur when you buy your property. They differ from state to state and sometimes even from county to county. Know how much you will have to incur and factor that amount into your budget to avoid any nasty surprises and ensure your investment will be profitable. You really can go on paper from a very profitable purchase to something that all of a sudden you're praying will be break even because you didn't anticipate maybe things like increasing property taxes or insurance rate increases and things of that nature. Number 7, capital growth potential. What factors point to the potential profitability of your real estate investment? If you're looking at an emerging market, which economic or social indicators exist to suggest that property prices will increase, what are you going to be doing about it? If you're buying a rental property, are there any indications to suggest that rental demand will remain strong, increase, or even decline? Think about what you want to achieve from your investment and then research and find out whether your expectations are realistic. Number 8, exit costs. If you will incur a substantial capital gains tax liability if you sell your investment property, then will that render the investment profitless? Again, what looks good on paper or on an Excel spreadsheet may not be reality if you don't factor in all of these elements that are involved in the sell, if you are going to sell it and not hold on to that. Number 9, profit margins. What levels of capital equity growth can you realistically gain in your property investment, and how much rental income can you generate? Allow margins for declining values and reduced rents. Now I'm going to emphasize that again. Allow margins for declining values and reduced rents. And this pertains not only to price and your current rent load, but also things like your loan. If your mortgage, for example, is a possibility of going up or changing, you don't want to buy variable. You want to buy fixed, and you want to buy lock it in for a 30-year period. Even if you're not going to hold the property for 30 years, you really want to try to get the favorable loan rates so that you have reduced mortgage payments. Work out these facts and then work backwards towards your initial budget to work out your potential profit margins. At all times, you have to keep the bigger picture in mind to ensure that your real estate investment has good potential for profit. Number 10, think long term. Okay, and I emphasize this. I know a lot of investors right now that are buying for the long term. They're not just going for the 3 to 5 year flip. Buy it and boost up the equity, and I mean that's great for investors, and boom, that's the kind of stuff you want to try to do if you have a solid investment team that you're trying to give continually good returns to. But unless you're buying property for short-term gain and intend to flip or wholesale it, which I wouldn't recommend in this market, you should view real estate investment as a long-term investment. Real estate is a slow to liquidate asset. Cash tied up in property is not simple to free up. Take a long-term approach to your property portfolio and give your assets time to increase in value before cashing them in for profit. If you set yourself with that understanding that you may hold on to it for the long term, then I think you're not going to be disappointed if you don't have that big huge gain that you're expecting in 3 to 5. If you do get the 3 to 5 or maybe even 18 months, you boost up and double the value of that property, well, great. But I think it's hard to plan that in today's market. Those are ideas primarily geared towards those that want to continue to purchase. But then there's another strategy, and that is to not buy, but to wait. Wait till the bargains hit the market. As the correction takes place and prices go down, there are those more conservative investors that don't want to, build up their cash reserves now and prepare so that they can buy some great bargains ahead. And here are a few tips for those. Number one, put less emphasis on leverage. A lot of times, we're growing and we're trying to do things fast. Leverage is without a doubt a great way to grow your portfolio quickly. But market variables have to be right for leverage to make sense. With increasing interest rates, less favorable loan products, and property prices increasing or on the decline, it's not a good time to leverage. Number two, optimize your current investments. Instead of buying new properties, concentrate on reinvesting in your current properties and trying to again, make a more efficient operation there. Everything from upgrades and improvements that will reduce expenses to maybe refinancing or doing something to get a more favorable loan rate. And number three is, I just mentioned, to refinance. If you can get decent interest rates, refi to reduce your mortgage payments. Again, you're cutting your bottom line expenses here, so you're trying to drive up your ROI. You can also try to accelerate your pay down on your existing mortgage. If you have the cash and you can apply it, sometimes it's a small amount each month, but that can make a huge difference in paying off that mortgage. Well, these tips hopefully will either in the acquisition or the wait and see stages of your investment strategy should be able to help you at least to get your eyes focused on the kinds of things you need to buy in a market that is slowing down. Well, that's it for today. Please note, Old Dog listeners, everything presented here today, including the links, will be accessed in our show notes on the Old Dogs website at olddogsreinetwork.com/blog. And just look for the episode entitled 10 Tips for Buying Rental Properties in Today's Slowing Market. Until next time, remember, cash flow is king and real estate investing the means. Thanks again for listening. And may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.